I'm not going
Yeah, we
to
got
about the belt.
As you know, like a lot of times I don't necessarily talk about investing. I talk more about planning, but since we have some guests and some new individuals, I'm going to talk about a little bit of both. So I've been a financial planner for about 25 years in different capacities and different roles, and in the essence of time, I won't get into that. But one of the reasons I got into this was to help people. One of the first interviews I had, and some of you heard me say this, was they said that you can have the mind of a capitalist and the heart of a social worker. And I just thought that was a great thing. It was a great way to kind of use the knowledge that I had and the experience that I had to help make people's lives better. And really what financial planning is sort of helping people accomplish the goals that are important to them. So I just want to kind of quickly review the process and just talk about a couple of key areas today, some topics of interest. So the idea is that when you're working with a financial planner, it's a process, and some of you have met with me or are working with me and have an idea of that. And the idea is you'll meet with people to try to find out what they're trying to accomplish, what's important to them, what their current situation is, because you're trying to tailor what you do to what they need and what they want, right? So once you've done that, you'll start assessing their current situation, what they're doing well, what they're not doing well, if they have excess cash flow, if they're break even or have a shortfall, prioritizing those goals, kind of figuring out what's realistic, what's not, making those trade-offs. I tell people, listen, I can illustrate any goal you want. That doesn't mean you can do it. If you make $50,000 a year and are in the hole every month and you want to buy a $2 million house in Cape May, well, it's probably not going to happen. I can show you what it costs, but that doesn't mean you can magically do it, right? So part of that process is having that conversation and brainstorming the priorities and the changes. From that, you figure out some scenarios and options that are available to achieve that and distill that down to what you're comfortable doing, right? So if you want to retire and there's a shortfall, maybe you have to save more now, maybe you retire later, maybe you spend less now so you have more later. Maybe you agree that, well, I wanted to travel a lot in retirement, I don't want to make other changes, so if it means I don't travel as much or do things, that's okay. We kind of brainstorm those options. Once you've done that, then we'll come up with what we're going to recommend and a schedule to implement. But also one of the most important things is that when you're putting a plan together is who's going to implement and how, right? There's things that we do, for example, so we may help people with managing their investments, we can do their insurance, we can review a lot of their estate planning documents, their tax documents, and make recommendations. But ultimately, there may be things that they need that they may need other people to do. That's one of the reasons that I belong to this group, for example, not just for me, but for people that I work with, right? If somebody's buying a house, they need a real estate agent or a title agent. Hopefully I'll be able to help you with that one of these days. You know, once they get in the house, then of course they find out the electrical's messed up, or they realize their bill's too high, so they want solar, or their homeowner's insurance is lousy. So then we'll work with other professionals to help implement that. And the main point of this process is that it's designed to be implemented, right? So if I put together a proposal or a report and they don't do anything with it, it's like, okay, basically you wasted my time and your money.
Right.
So one of the things that I try to tell people is the objective is to implement the plan. You know, one of the things that's a little different for me is that a lot of people in my industry, especially people who've had the years of experience that I have and the credentials, will not work with small clients. I will. And part of the reason is that I got in this to help people. And I think you can work with somebody who's a smaller situation as long as you're managing their expectations, right? So if you're in a small situation, yeah, I'm not going to necessarily be able to do very complex scenarios and detailed planning or whatever because it isn't cost effective or time effective. The good news is we're independent, so we have different ways to, you know, charge for that if somebody really wants to do that. So I have some flexibility there. But the main point is that, you know, I went to a conference not too long ago and they were talking, one of the advisors on this panel was talking about this, and they asked him if you had somebody who was kind of modest needs and they came to you, what would you tell them? And they basically said, come back when you have some money. She said it a little nicer than that, but that was basically the idea. Sort of the same idea, like banks only lend you money when you don't need it. Now, if it's me, right, and I do this sometimes now, like I get all these credit card offers in the mail after I kind of paid off some bills. Well, when I needed like Discover, I hate Discover because and they send me like a letter like every week I get a mailing from them. But when I needed a little more credit to kind of clean some stuff up, where were they, right? So my feeling is that if you weren't there for me when I needed you, and now I'm there, I'm gonna go with the person who was there to help me. So my feeling is, and you know from some of your clients that you referred, some of your smaller ones, I wanna grow with them, right? To me, that's the reward. Somebody who is wealthy, and we're helping them with their taxes or estate or whatever, yeah, that's great. But somebody who's just starting out and you kind of build that legacy for them and grow with them over time, that's what this is really about. So one of the other things about what we do is everything fits together. When you were talking a little bit about trading and stocks and all that, the thing about investing, and I'm going to pivot to that for a few minutes, is that there's a difference between speculating and investing. Okay, so speculating, where you're basically trying to make money on individual stock and grow or whatever. Investing is really nothing more than the gas to get you from point A to point B. You can have economy, you can have high test, right? And the idea is that how comfortable you are with risk, how much time do you have, what are you trying to accomplish? Because ultimately, when you're growing wealth and saving money, you're doing it for a reason. You're not doing it so you can be Scrooge McDuck sitting on a pile of gold or something with your hat and looking down at everybody. You're doing it because you want to accomplish something, right? You want to buy a bigger home. You want to send your kids to college. You want to take more vacations. You want to be charitably inclined or have a legacy, whatever the case may be. So the idea is that when you're trying to pick an investment strategy, and I was talking about this with my students last night, it's about tying it to what you want to do, right? And it's not as complicated as people think. If you've noticed, I rarely talk about investments. I rarely talk about performance, and part of the reason for that, let's see how we're doing. It's commoditized. You can get a lot of the information that I can provide you. There's tools you can use. Some financial services companies have self-service options or call centers. But the big problem with that is, first of all, it's not necessarily tailored to you. Second of all, fine, you get all this information. What do you do with it, right? So you can do research on investments. You can learn if this is a good company or not. Okay, so now what? How much do you save? Where does it go? What are the tax implications? Is this too aggressive or too conservative? Does it make sense for you? You get all this information, you have no idea. So the idea is to sort of tailor what you're doing to that person's situation. But the biggest thing about planning is that all of these things fit together, and that's one thing that a lot of people don't necessarily realize. Everything affects everything else. So you're investing, right? Let's say it grows well. Okay, well now you have a tax issue you have to deal with. So you need to make sure that you're tax efficient in the investment. Or maybe you now have an estate planning issue. Or you need insurance, so you buy a lot of insurance. Okay, well now you are spending so much money on insurance that it's impacting your ability to save for your goals. I'm a big believer that you don't want to spend more protecting something that impedes your ability to have it, right? If you are buying a home, right, and the home is too expensive, and now it's impeding your ability to save for college or do other things. So the idea is that all of this has to fit together to make sure that you have a cohesive plan, and people don't necessarily think about the fact that you need to be looking at your taxes, education, estate planning, risk management, goal accumulation, your cash flow, your emergency fund, and doing it in the most cost-effective and tax-efficient manner. Ultimately, if we're doing our job right, we shouldn't really be costing you money. It doesn't mean I'm going to work for free. I have bills to pay just like everybody else. But the idea is that if we're able to improve your cash flow, maybe help you with your debt, help you get a return that's more consistent with what you're trying to do, keep fees reasonable, taxes reasonable, you're better off. And that's kind of the idea of the process. So let's talk a little bit about investing for 5 minutes. So there's a couple just key points I want to make about that. So if you remember when I was showboating a couple weeks ago, I gave you that chart, right? Some you didn't see it, and it was very colorful and had different types of investments on it. And what that was really showing you was the idea that there is no discernible pattern of what's going to do well at any given time. And that's the problem. People are always trying to chase the wave. So there was a study by Harry Markowitz, who is the father of modern portfolio theory and asset allocation, okay? He won the Nobel Prize for Economics in 1990. And what he found is he was actually doing research for institutional pension funds from the 1950s through the 1980s, right? And what he found was that overall investment returns are based on three things primarily, okay? The diversification, asset allocation of portfolio, market timing, and security selection. So show of hands, who thinks that market timing is the number one cause of investment performance? What about security selection? You pick the right securities. Sorry. Asset allocation, 91% over the long run. Yeah, sure, you can get lucky and hit a hot stock or whatever, but that's not really investing for the long term. That's speculating and trying to grow, and you may get lucky, right? But the idea is that no one knows what the market's going to do. Guess what? Yesterday, I was so busy with the house and my class and all that, I have no idea what the market did yesterday. And you know what? I don't care. Hopefully it was down because yesterday was the day we put money in our daughter's college account. We do it once a month. And that's actually one of the best ways to save on an incremental point. One of the things I was showing my students last night, for example, was using an example of saving $200 a month, right? Every month for 20 years, okay? It's $48,000. Okay, if you invested that like in an S&P index fund for that 20-year period, that $200 a month would be worth about $150,000. $200 a month is less than my cable bill. I tried to get Comcast to lower it, they were not feeling it. But, so think about that. Now, the goal is to buy low and sell high, right? But when is that? Okay, do you know when it's going to be low, when it's going to be high? Right? Have no idea. And what people do, they'll get out because they're worried about losing money, but they don't know when to get back in. So part of it is having a consistent strategy over time that's tied with how much risk you're willing to take, how much time you have, and what the goal is. So for example, saving that $200 a month, let's use that as an example. And you do it every month, maybe the 1st or 15th or whatever, right? So if the market's higher, you're buying less shares with that $200 a month, right? If the market's lower, you're buying more shares. So you're effectively doing it automatically. Many of you are doing it without even realizing it through your retirement plans through work, because it's coming out of your check, or maybe you're contributing on a systematic basis. You're not trying to time the market or pick the stocks. You've developed a portfolio based on your risk or what the representative told you to do, and it just goes in every month. You don't even think about it. And one of the best ways to do that is that process, because you don't worry about the market, you don't get emotional about it. You just treat it as a bill. Like every month I know $350 is going to come out every single month from my daughter's college account. Every month, okay? It's a bill. I don't think about it. It's done. I don't know what the market's doing. I just always hope that on the 16th that the market's down that day, since that was the weekend, it was yesterday, it was a holiday, right? So, but over time, that's going to build a lot of wealth. And the mistake a lot of people make is they don't want to do that. They want to speculate. They want to gamble, right? And that's not, and yeah, you might get lucky. And you know what? If you want to do that, that's okay. But it's got to be money that you can afford to lose, right? So one of the things we were talking about was risk tolerance. And I'll close with this and then give it 2 minutes for questions, because I know we have to wrap things up. Is when you think about risk tolerance, there's the willingness to assume risk and the ability to assume risk. You need to have both. So let's say you have a lot of money, but you're not willing to take any risk. Well, then don't, okay? Because you might be able to do it, but if you're not willing to do it, what's going to happen when there's a correction or an event? And there always is something, right? Always. We had the financial crisis, we had COVID, we had 9/11, we had the Iraq War, we had the Asian flu. There's always going to be something, right? When COVID hit and the market went down, out of all my clients, 2 of them reached out to me. Some other ones I reached out to them just in case. And you know, most of them said, I kind of have them trained at this point. It's like, yeah, we know. Leave it in, we're fine. We've seen this movie before, we don't care, right? So you have to be comfortable with that. Now the other side of it is, just because you're willing to do something doesn't mean you should. So let's say you just got your first job, and you got your first paycheck, and yeah, you paid your rent and all this, so you're like, you know what, I'm gonna take all of this, and NVIDIA's been going like crazy, so I'm gonna take my whole paycheck and buy NVIDIA, right? And NVIDIA's a solid company, I think they have good growth potential or whatever, but let's say a month later, you know, your car won't start, right? And it turns out that it's not the gas, it's that it needs an engine rebuild, and you need to come up with $3,000. And to get your first job, your first apartment, you have no insurance, no emergency fund, and no credit. But you have the money that you put in your paycheck in the NVIDIA stock. And NVIDIA just got some bad news about whatever. And every once in a while they get bad news, people overreact. You have no money. Your car is dead, and you need to get to work. So what are you going to do? Where are you getting the money? NVIDIA. Meanwhile, NVIDIA, even though it might be a great long-term hold, just dropped 20% because you've seen that happen, right? But you need the money today, because if you don't, you're unemployed. You're taking the loss, right? So it has to be, so even though you might be willing to do that, you should because of your circumstances. So the idea is trying to educate people to do that, make sure they have the foundation, make sure that when they're focusing on their goals, that what they're investing in, what they're saving in, what they're planning for is consistent with that. And that's kind of the process in a 10-minute nutshell. So quick questions, I know we've got to go around the room. Yes, sir.
What's your preferred age to work with somebody? I know you can work with anybody, but you find young people more rewarding?
No. I think because they tend to, they want, I'll rephrase it. Some young people, if they are receptive to advice and they are willing to be coachable and they want to grow with somebody. But I find a lot of younger people, you know, they may be do-it-yourselfers, or they're thinking they can do everything online, they don't need a person or whatever, and that's fine, okay? That's their preference. So I would say probably my preferred would probably be 40 to 70. People who are kind of mid-career to pre-retirement, I would say is probably the dual income professionals. I work with some business owners, but I find that some business owners that they get so bogged down in their business that sometimes they will blow you off because it's like, oh yeah, I know we had a meeting, but you know what, there was an emergency and I had to take care of this or whatever. I get it, okay? So I would say my sweet spot is probably the dual income professionals that are not there. One of the things that I'll say, and I'll close with this, part of my elevator speech is, you know, a good referral for me is someone who has the means, the method, and the desire to achieve their goal, right? And I'll give up my 30 seconds. So
you can take all the time you want.
And the means is you're there, you have the wealth, right? The method, and I just made this up when I, like, as an aside, the method is you don't necessarily have the wealth, but you have the income, meaning you have the ability to build wealth. And the desire, maybe you don't have either of those things, but you have an intangible. Maybe you just start a business, or you just graduate from school, or you finished an internship or residency. Or maybe you know a lot of people that can be a good referral source. Or maybe you are super committed and super disciplined to where even though you don't have a lot of resources, you have the ability and desire to save and are good to work with. Any of those people I'll work with, yes.
How often do you change investments for your clients?
Every day, we day trade. No, we don't do that at all, actually. But what we do is actually we have, for example, in our firm, we have an investment committee that reviews our portfolios, right? And we have portfolios based on tax efficiency. Some are all stocks, some are a mixture of stocks and mutual funds. Some are all mutual funds, exchange traded funds. So we have somebody who works for us full time, and actually all she does is review and screen a lot of the securities. So what we'll do is we will review those portfolios regularly, And I would say usually, when the quarterly statements come out, we will review them. When we update our portfolios, a lot of times what we'll do is we'll rebalance the clients. For retirement accounts, we can do that relatively easily. For taxable accounts, that can be a problem because if you have to change things, that can create a tax consequence. Where retirement accounts, it doesn't matter. But the idea is that we want to keep an eye on this fairly regularly, and we'll change it as needed. Overall, we don't try to be reactive though. The idea is to develop that portfolio and keep it relatively stable, just maybe make minor changes as if there was a reason we might want to get out of a particular holding, or maybe if the client starts getting overly concentrated, maybe we'll rebalance it once or twice a year.
Okay.
Yes.
And going back to your the handout sheet that you had a couple weeks back, it seemed like a fairly cyclical thing, and not that you can predict the future from it. But are there any trends of things that you see now that either people should be getting out of, or maybe putting more dollars in over the next 4 or 5 years?
Well, what I would say is that, and this isn't about politics, okay? I've actually put my head in the sand and stopped watching the news. I watch enough to make sure that I'm informed. But from some of the emphasis it's very clear that technology in particular, I think, and growth is going to be a sector that's going to continue to evolve. I think AI is just the beginning of it, sort of like where the internet was, maybe around 2000. So I think there's a lot of potential there. So I definitely think that there's an opportunity there. I also think that the energy sector is going to continue to, there's going to be more emphasis on the energy sector. So those are two in particular that I would certainly keep an eye on. Yes.
About now, I never had stocks or anything, but I did get some from my aunt. Prudential stock,
I
common
work
share.
for Prudential.
So did my dad. But now, what do you think it's a good idea to keep them? Because I just had to settle her daughter's estate, and they combined them. Should I keep the Prudential stock, or should I sell it, or is it a good stock to have? Does it grow often? I noticed it goes between like 90 and 120.
Yeah, I mean, stocks of insurance companies, banks, financial services, generally they're what's known as a value stock, meaning that they often don't necessarily grow a lot, but they tend to be fairly stable. So as you notice, they don't necessarily move a lot in price, but they tend to also produce a decent amount of income in the form of dividends. So it depends on what you want to do with it. The other issue is, okay, depending on how you got it and the circumstances, what are the tax consequences of getting rid of it? Generally speaking, regardless of the stock, I always recommend that people don't necessarily have a large position relative to their overall worth in one particular stock, because then you're tied to the fortunes of that company. If the company underperforms, or if there's accounting problems, or the CEO gets indicted, or whatever the case may be, or there's a lawsuit, you're tied to that one company, whereas a mutual fund might have 300 companies in there. So if that one company is in trouble, so what, right? But if that's a very large percentage of your holdings, it may be worth considering. I would say, and I offer this to anyone in the group though, I'm more than willing to, where we could do an analysis of the portfolio, and it's objective. It's not designed to be solicitous in any way. It basically just looks at the numbers, what the return is, how it's returned relative to similar companies in the industry, how everything fits together as a portfolio, how it's performed relative to the indices, how much risk you're taking relative to the indices. And I think it's also good because all of you will get a better feel for some of the things that we do. And that way also, if you come across people who need our services, it helps you have a better understanding. Other questions?
Young people are important. I have trouble getting them in my business. My clientele is 40 and up. They're stable. They appreciate what they have, but the young people think they can go online and do it themselves. I insure my son only because he's my son. Otherwise, he'd be online. And I think if the money is going to pass to generational wealth, and the young people are not nearly well trained by people like you, what you do is very important, then you might be facing a similar crisis. You won't, but 40 years from now.
Well, one of the things that happened is, and you met one of my colleagues, yeah, I saw that. You met one of my colleagues, okay? He came to my place one day,
Tall
was
guy.
stitched up, right?
I was gonna get him a basketball.
Yeah, so he inherited, they actually acquired a practice of an advisor retired who was in her 70s. So all of her clients were in that age group, and they had the same issue. So one of the things that they've been doing is they've scheduled a lot of the review meetings with the parents and the kids together, right? And also reaching out and providing, try to provide services for the next generation to kind of introduce them to what we do and how it works. I need to do a little bit of a better job in that. My clients aren't quite old enough to where I have to, but there's a few that I should, and that's an important thing, right? You need to train them. But I want to give everybody time to, to do their quick commercial, so.